Welcome to Quiver Financial's market report for March 2025. A lot of big shifts in financial markets as February comes to a close, and markets seem to have some anxiousness around the Trump era tariffs and what they mean for inflation, the consumer, and stock market performance. With interest rates plunging this week and the tech sector having some jitters in the stock market, find out why we're singing along with Mick Jagger and the Rolling Stones and why we bought and sold stocks like EPR Properties, Google, Microsoft, Amazon, GLD, and many more. You can't always get what you want. You can't always get what you want. But if you try sometimes, it just is fine. You get what you need, and that's what happened this week, folks. In the markets, we got what we needed. Interest rates plunge, tech stocks sell off. Maybe there's an entry point coming here. See why we are singing with the Stones this week, because it was a total week of we got what we needed, not necessarily what we wanted. Doesn't mean we won't get that next week, folks. So I'm going to go through the charts of the 5 things we always talk about, the 5 macro themes that make the biggest difference in your net worth. Things like real estate, the stock market, the US dollar, commodity prices because of inflation, and real estate prices. Those are the 5 things that typically have the biggest influence in your net worth. That's why we talk about them at Quiver Financial, because diversification is not enough. You've got to have diversification with non-correlation, and that's the big recipe people really forget about. So we're going to talk about what we did this week, because we had a lot of activity this week. We bought and sold quite a few things: EPR Properties, Google, or Alphabet as it's known, Microsoft, Amazon, GLD for certain clients, and quite a few other things. So it was a very active week for us. So let me jump right into it and get into what matters to you, especially if you're a Quiver client. Like we said, it was a week of not necessarily getting what you want, but we did get what we needed, because we've been a little bit light on the stock market in our portfolios, especially tech. We've been showing in the charts that we felt that it was a little overvalued. We've been showing you certain levels. This week, we got some good sell-offs in tech, so we're going to show you those levels. And we're going to talk about, is a market crash coming, or is this a buying opportunity for certain kinds of people who might have the right risk tolerance? Oil and energy. I mean, come on, oil. Geez, wow. You got one job. That's go up. And this week, this was a perfect example of we got what we needed, not what we wanted. Oil prices, energy sector, they hugged their support levels, but we didn't get above them. I'm going to show you some charts. Patience is going to be needed. I'm going to show you what we want to see over the next couple weeks. Gold, we did somebody say last week that maybe it's time to create a little bit of a sell strategy around gold? Well, guess what? This week, it had a little bit of a correction. I don't think it's all that big of a deal. In fact, for some of our clients that were new to us, we're taking the opportunity to start some positions. So we'll show you on the charts what we're doing there and what we did this week. And the big, huge story this week is interest rates. The 10-year Treasury, folks, we've been talking about, could we close below 4.4%? We did for like an hour, and then all of a sudden interest rates plunge straight down. I think we're closing this week somewhere around 4.25, which is exactly where our first initial target was. So this is where we got what we wanted. Listen, Mick, we got what we wanted here, buddy. So I'm going to show you on the charts what could happen next, because I would expect a little bounce higher in rates over the next couple weeks, work off some of this oversold side. And we'll be able to decide what to do there. But we made some moves in both EPR Properties and Annaly this week that you're going to want to see, especially if you're a Quiver client. So let's get started. We always invest around themes. I mentioned earlier, there's 5 macro themes that we believe have the biggest influence on your net worth. It's things like interest rates, because interest rates, whether they're going higher or lower, they're going to have all kinds of effects on real estate, treasuries, even utility stocks in certain cases. And if interest rates push too high, they can derail the stock market. So we've been talking about the 10-year treasury staying between 4 and 5%. We're getting what we want there. I'm going to get really detailed into the charts on rates and what to expect over the next couple weeks and how to invest around it. Stock market, we've been saying for a while, it's tired. It was ready for a correction. We're lovers of tech like everybody else. We like to pair it with utilities and energy. However, we've been light on tech at the turn of the year because we thought there was a correction coming. It looks like that we are seeing that as we speak. Metals have been in rally mode. We think that continues. However, this past week, we got a little bit of a step back. I don't think it's anything more than a correction. If you've been waiting or wanting to get an entry point into metals, this might be it. Do realize metals have been running for a while, so whatever you do here, do it in smaller capacities. And then oil, we were saying that oil would break out at some point. It did in January. We believe that that kind of breakout that we've seen, and I'll show it to you in the charts, should lead to a multi-year move. But there's a lot of rhetoric around this because you've got drill, baby, drill. Trump and Bessent, they know the only way that you can get interest rates lower is to get inflation lower. You got to get energy prices lower. There's a lot of hurdles. In the last couple of weeks, we're concerned about, hey, if there's a peace deal with Ukraine, does that bring more oil on the market? But every time something like that happens, then you get another shutdown somewhere else, either in Iran or Venezuela. So the big question is, will oil be the Trump administration's kryptonite? They need it to go lower, but the charts really aren't supporting that. So I'm going to show you what happened this past week because we got what we needed, not what we wanted, which was oil and energy held where they needed to, but they're not springboarding higher like we want them to. So let's get started with what we wanted first, folks, which is interest rates, and the 10-year treasury is usually what we talk about here. We've been saying, we were early in this, we started saying right around here in 2023 that the 10-year treasury looks like it wants to stay in this Goldilocks range between, we were saying 3.5 and 4.5. We've kind of revised that now to be between 3.5 and 5% based on some of the activities that's happened since the first time we identified it almost 2 years ago. That's crazy that we were that early in thinking that rates could go sideways. The reason we identified that as one of those 5 factors we look at is that if you can get rates going sideways or lower, it's a great time to be in things like treasury bonds and traded REITs if you're an income seeker and you're looking for a prudent approach to things. So what's happened over time is this past year, now I just shortened up the last chart I showed you there was over a long period of time from 2022 to now. Now I'm just showing you over the last year that we shared in February that at the start of February, we had this little danger, Will Robinson spike up in rates around a CPI report, and it started to make us feel that, are we going to run up above 4.75? The subsequent weeks, we got what we wanted because not only did we break below 4.5, but as soon as we did this, starting on Monday of this week, we reached 4.25, our first target. Boom, like that. I mean, we didn't expect it that fast, but it is what it is. We've been saying that if you could get the 10-year treasury to get down towards 4.25, that maybe traded real estate trusts would be accretive to a portfolio. So, we pivoted right at 4.75 earlier in the year. We broke below 4.5. We've reached our target. We got what we wanted at 4.25. So now what? What I would expect is normally this little 4.25 should be support. So I wouldn't be too surprised that over the next 2 weeks of first start of March here, if the 10-year treasury makes a bounce back up to 4.5. That wouldn't concern me at all. Really what I want to see is if and when that happens, how do these traded REITs behave? Do they just fall apart? Do they just run for the hills on that move? Or do they continue to grind higher or at least just correct sideways? What I'm really going to be watching, what's more important, is if we do come back to 4.5 in the next couple weeks, that's what I want to see behave, because what we want to see to be able to hold interest rate sensitive investments in a portfolio over the long haul is we want to see a situation where it reaches 4.5 and fails and comes back down towards 4.25 and maybe even lower. That would be ideal. I think oil prices, a lot of other things are going to come into factor, and that process of bounce to 4.5 and back down, if that happens, could take 3-4 months. So it's something to stay on our radar. The great part is we're getting what we wanted so far. So what does this mean for some of those traded REITs we've been talking about over the last few weeks? Because in January, you can see here, what was that, January 10th, we identified that, hey, maybe EPR properties, if you had the right risk reward type of profile, if it held this 44, it could be a great pivot level. And sure as shit, that's exactly what happened. Oops, I went backwards, not forwards. We went, not only, did it hold 44, but in the last 3-4 weeks, we've sprungboard all the way up to 50. What is this? 50, over 52, approaching 53 here. Move was so fast, and the next dividend for EPR, I think, is at the end of April. It's a little ways away. So because you never go broke taking a profit, for some of our clients and in some of our models, we have started to trim a little bit of our EPR. I haven't removed it because realize how we operate at Quiver is if we want 10% of something in our portfolio, 5% of it or half of the position is a core position. We can just hold through the ups and the downs as long as the long-term trend is intact. The other half, the other 5% is like, picture it like a satellite where we will buy and sell. So as the market runs up, like it has here with EPR, we'll start to take that satellite position off. And then as EPR inevitably will correct and come back to a level of support, we'll put that other half back on. This is the way that we add value for our clients in mitigating risk, because you never know what's going to happen next. However, simple principles like you never go broke taking a profit, and by trimming positions and trading around a longer term trend can help make sure that you don't wake up one morning with a rude surprise. That's what somebody who's managing your money should be doing for you, is mitigating the risk through some kind of tactical and strategy. And that's what we're doing here. And this is a great example of how we identified an asset that pays a great income at a level of support, entered, and now we're starting to manage the risk of that position by taking some of the profits. So that's a great example of how this, just it's a textbook. I mean, at the end of the day, Annaly property, same thing. We identified this around 18 in the early January. We wanted to see if it could get up to 20. It sure as hell did. It's got up to 22. Again, not another dividend for a few weeks. So we did trim a little bit of this week. Not that I don't like it. It's just I wanted to remove some profits. What I ended up doing with some of those profits is you can look at something like the Nuveen Real Estate Trust with the symbol JRS. It has not had this kind of run, so I actually pruned some of these and repositioned it over to JRS, because thinking that maybe that will have some catch up if rates continue to go lower. That will have some catch up if rates bounce back up. It looked like it was at better levels of support, whereas Annaly and EPR are pretty far away from support. They're pretty far away from the 200-day moving averages as well. So they're pretty overbought at these levels. So that was just how we kind of did some risk mitigation, small adjustments in the portfolio this week. Moving into energy and metals, and something that we got what we needed, but not what we wanted. What we wanted is we want to see energy and metals to move higher, not for our pocketbook, not for inflation, but for the holdings that we have in there. Now, I'll tell you one thing that's happening is CNBC is starting to talk about energy a lot more as like, oh, it's a contrarian play. So that's really interesting because 6 months ago, they didn't even talk about it. So it's starting to get some interest as the market has seen a correction in technology stocks. People are kind of spreading money out, and some of it does seem to be going into things like utilities and energy. So to take you back in time, we've been talking about this pattern in oil. This is a chart of oil over the last 5 years, let's call it. And this kind of pattern, we've seen a million times. I talked about it, that it consolidates down. And then when it breaks out, that the direction of the break tends to be the meaty move. And we broke out in January higher. And now, after that breakout, which is essentially a short squeeze that's happening there, we correct back down to a level of support. And we've been saying we really need to hold this level of support in order for this pattern to continue to be bullish. It's going to take some patience because you can see over the last 2 weeks, we keep hugging this line of support. This little skinny line here is the 200-day moving average, and we're hugging that. We really want to see over the next 2 weeks get above that 200-day moving average with an increase in volume, a little bit of a thrust. When it comes to the energy sector, now I switched up the chart to XLE, and it's very similar. We're holding our lines of support. We're holding the line of the 200-day moving average. It's going sideways. We really want it to tilt up and start to go up. So the next week is really crucial for oil. There's a lot of news with Ukraine and a peace treaty. Does that help oil go up or down? We're going to find out real soon. So stay tuned because as that happens, we may or may not need to make some adjustments to the portfolio as it sits. Moving on to gold, we had said last week that gold was starting to get parabolic in a long-term move. We looked at this, we showed you this long-term picture since 2015, so the last decade of gold prices. I was showing it as just a warning sign saying that if you're really jumping into gold, be careful, start small, because when moves start to get parabolic like this, that's when you should start making a sell plan, not a buy plan. Now, what happened this week, we've had a nice little pullback, and it looks like gold and silver are pulling back to levels of support. Silver's actually coming right into its 200-day moving average, whereas it looks like gold is just coming down right into the breakout level from where it broke out a few weeks back, or a few weeks back. So what I'm expecting here is hopefully next week we'll get some footing right around or above this support level. And if so, if you've been wanting to get into gold and silver, that might be a time to start paying attention to it and start doing small purchases. Realize you're at the high end of the range. However, if you're really feeling a few weeks ago you were missing out on stuff, now gold's actually maybe giving you a little bit of an entry point as long as your risk metrics can handle it. This isn't investment advice, folks. This is, if you want to know if your risk metrics can handle it, call me and we'll have a deeper conversation. So that's what's going on in energy and gold. Essentially, we didn't get anything that we wanted this week in those things, but we did get what we needed. So stay tuned. Moving on to equities, I want to show you some of the things that we did buy and sell in the portfolios because tech is a wreck this week, folks, which is actually a good thing for us because there's been quite a few things we've had on our radar that we wanted to add to the portfolio, and this might give us a chance. The last few weeks I've been sharing with you a long-term chart of the S&P 500 as a warning sign saying, hey, realize this bull market is very long in the tooth. At some point, we're getting to the point where if and when this rally ends, we could go into a recession or an extended bear market where there's a year and a half or so where things just aren't that great. It's just the way things work, buy low, sell high. So we're getting into those high points. Nothing has happened to make us want to get out of the market yet. I'm just saying for warning, be careful if you're new to the market. It looks like there are a lot of new people because all the small speculators are in. I've been doing this 20 plus years, folks. Every time the small guys are in, every time retail's in, you're closer to a top than a bottom. Institutional guys are early. So just take it for what it's worth. The old saying, be fearful when others are greedy and greedy when others are fearful is really to take at heart. What we do at Quiver is when you get into these extended rallies, we start shortening up our grip on the bat and we start looking at things week by week. So we've been sharing with you what are our levels. This is the S&P 500 last week, and we said we really wanted to stay above that 6,000 level. That's the warning zone. A break below there starts to open up the door that we could have a deeper correction. This week, we broke below that warning level and reached the next level of support like that. So now, over the next week, we want to see if equities can hold this green line. Basically, this is a breakout level that the equity market is coming and retesting. It's already tested a few times, so this is not great for momentum. You really would have preferred that we stayed above the red line, because by doing so, the market's momentum is a lot stronger. So it doesn't mean the momentum is broken. It just means that you should be a little more cautious in your risk management here. Now, on a highlight from a buying aspect is the Mag 7 stocks. A lot of them have seen pretty decent corrections. I'm going to show you a couple charts of them. So really what we want to see over the next week is, does this line hold that we have here? Can we get a bounce back up towards and above 6,000? And if so, does it look like something that'll make a new all-time high or roll over and fail? I have a feeling that the overall equity market really wants to trade sideways here for a few months, maybe into summertime. So I could see where this green line holds at first, and then we spend a few months going sideways, because when I look at the Mag 7 stuff, like for instance, top right, Amazon's already down about 8% for the year, since its highs after it reported earnings not too long ago. And right on a line of support, not too far from its 200-day moving average. So we did, in our portfolios, increase our allocation just by a very, very, very small amount. So we're watching this, and if these levels of support can hold over the next 2 weeks, we may continue to add to those positions. We do this in increments here, folks. Microsoft, top right, it's down about 12% from its highs here at 465. So, decent little correction, again, on a line of support. It's vertical support, or I'm sorry, horizontal support here. We'd prefer it to be tilted up a little bit. So this is a good example of how it's lost momentum and is going sideways. So this next bounce, if and when you get one, will be real important to watch to see, can you continue to add to Microsoft over time. Google, the top, bottom left here, it's had the biggest correction. It's down about 18% since when it reported earnings, and just broke the 200-day moving average, which is not great, but it is on sitting near support. So the next 2 weeks, we'd like to see that turn around. So all three of these this week on these lows, we did increase. Like if we had a 1% exposure, we moved it to like 1.5. So it was really, really small in our models, but we said to our clients we'd buy on the next dip. The next dip is here. One thing also that's been in the portfolio that we've been adding recently too is the utility sector, is the bottom right here. Out of all the sectors, it looks the best. It's the value play. This is a good example, and I'm showing it here because it's a good example of how the market is broadened out, where while the Mag 7 have started to go sideways and lose their momentum, things like utilities, energy, basic materials, regional banks, there's quite a few other sectors that have started to tilt upward in the right way. And that's a really good sign for the overall market, especially for people who like to have a diversified portfolio, because it's telling you that more money is getting spread about and not just in 5 or 6 stocks, which is like what we like to see. So next week, we're going to talk a lot about, oil and energy, I have a feeling, and also what happens in rates. If this was helpful for you, please like and subscribe. It's a really, really big help for us anytime you give it a like, anytime you give it a subscribe. I just want to close with, why do we talk about interest rates, oil, gold, and stocks? It's because those are the 5 things that affect your net worth the most. And if you can get the cycles right, if you can learn how to buy low and sell high on these cycles, you can really optimize your 401k allocation, your retirement plan allocation, your IRAs, all of those things. And plus, it helps you mitigate risk and avoid you from having a diversified portfolio that goes up and down with all the same holdings doing the same thing. So that's what we do here at Quiver Financial. I hope you enjoyed the video. Like I mentioned, give us a like and subscribe, and we'll see you next week, folks. Bye-bye.